Hello, I'm Rowan Ziegler, and I'm going to be talking about the copper arbitrage between London Metal Exchange and COMEX copper. Physical commodity markets allow for physical delivery, and that creates some interesting opportunities. If we look at the first chart, the LME approves a global network of independent warehouses, and they contain different amounts of good delivery metal, copper, aluminium, and the like. If you buy a position on the LME and let it mature, you'll get a random allocation of metal in one of these warehouses. If we go over to the US and look at the second chart, in the US you find COMEX copper warehouses and LME copper warehouses relatively close by. The cost to move between the two, physical copper, is about $70 or above per tonne, and that's down to negotiation. And if we look at the contract specs on the markets in slide 3, the same copper, physical copper, is delivered against both COMEX and LME, but there's some significant differences between the two markets. Contract size is 25 tonnes on the LME against 11.33 tonnes on COMEX. The initial margin on the LME is more than twice as much, and that becomes important later on. If we look at the type of business that COMEX attracts and LME attracts, they both have consumer forward buying, they both have speculative trading, and they both have arbitrage business. But producer forward hedging tends to prefer LME markets, which are deeper, and that means that the LME forward curve is often in a backwardation when prices are high, and COMEX copper, because of the consumer buying, tends to be in a contango. For the arbitrage, that means that COMEX copper tends to be at or a discount to LME on the nearby months and at a premium in the forward months. And this creates the conditions for one quite popular arbitrage trade. If we look at the fifth slide, the LME trader, or the COMEX physical trader, can buy LME and sell COMEX in the forward months, say 1 or 2 years forward, at say $70 per tonne. And then if the position matures up the curve in option 2A, they'll sell the LME and buy back the COMEX and lock in another $40. And so the paper closeout before costs is about $110. If you go back to the initial margin, for a 2-year initial margin at 3% on both exchanges, that's a financing cost of about $40, $45. So that really eats into the profitability of the arbitrage, and that's why a lot of the long-dated arbitrage business has died back. If you go to the second option, 2B, if the market doesn't, the arbitrage doesn't decay as expected and actually widens or stays the same, then physical traders can actually move physical into the COMEX and close out their positions, and that's something that financial arbitrage traders can't do. So physical traders have an advantage there. The COMEX and LME arbitrage is not always within $80. Sometimes it can move much, much further, especially in the nearby months. If you look at this chart, it shows some snapshots of the arbitrage curve from Q4, when the nearby months got to $200 above. LME got $200 above COMEX. And in the back end of the month, you'll see, even when the nearbys were really out of whack, the back end was still between $100 and $50. So looking at nearby arbitrage trading, to take advantage of 1 month arbitrage when it gets out of line, you need a very, very slick logistics operation, and you need to move very quickly, because losing even 1 month on the nearby, or delaying by 1 month on nearby deliveries, can cost $40, $50 backwardation sometimes. So currently the market's back in a normal range, around $50 either side, LME against COMEX. But just like stocks and spreads last week on the LME, there will be opportunities in the future to trade these again. Happy trading. Thank you.